Okay.
And I'm going to show you an example of how you can determine, like, so actually we could stay on this chart. And now this was just a daily example of just using simple equilibrium concepts of closes above equilibrium, then a pullback, right? That price is being purchased at a discount below equilibriums. We saw the first example of that based on the higher time frames quadrant equilibrium. We can clearly see that there's buying below equilibrium. So going forward, we can take the subsequent equilibriums as it relates to wide range bars and accumulative wide range bars and wait for closes and wait for pullbacks. And of course, using support and resistance concepts in confluence, right, to kind of give us more confidence. But you can you see how consistent this is?
Yeah.
It's almost like this is not an accident, right? It's
Right.
almost like this is how the market works, right? So, and
It really is. It really is following the smart money, though. I can see that clearly.
Right. So let's go down to okay, here's another piece of information here, and this of course is going to be probably in the area of minutia, right? This is just minutia.
Okay, so we've really gone through the most important concepts, and now we're just kind of drilling down a little bit here.
Right. Okay. Absolutely. So let's take a look here and see. So here's what I mean by this clue. Let me get this out of the way here. This clue that price likely wants to go higher and out of consolidations. Okay. And this is something I'm still working on, and I do pay attention to it. But again, the daily chart, as I just had pointed out, is really the deciding factor for whether or not trades should be taken. Okay, so here we are. All right, yes. Okay, let's see if this is, yeah, okay, right here. Perfect. This is a subtlety, so it might be, so if anybody's watching this and they're like, oh man, that's just way too much information. All right. Okay, so you see how price is moved out of this consolidation here. Now it's extended all the way down and then had this last bit of consolidation right here. Now I want you to see something here. Okay, I'm going to use a box for this.
And now we're on the 1 hour chart again?
We're on the 1 hour chart.
Okay.
So we want to look for clues that price is telling us that it's going to go higher. Okay. Now, if we also keep in mind the Wyckoff concept of accumulation, spring markup distribution, right? I like to refer to it the way that ICT, Mr. Michael Huddleston, taught me, is the business model of smart money is accumulation, manipulation, and distribution. Okay. When you see accumulation, you should expect a manipulation before any sort of distribution. Okay. So if this is an accumulation of a long position, I'm going to show you that here in play. Okay, so we're going to go to a black outline. Right. Notice how the first inside bar right here, okay? What I mean by that is the first bar that when price goes into this consolidation sitting just above this important equilibrium that we derive from the monthly chart. Mm-hmm. Now notice this first inside bar right here on the hourly. Notice how price dips below it.
Right? Okay, so an inside bar is just a bar that's inside the previous bar. The Correct. Previous bar is a wide-ranging bar, and the next bar that is inside of that bar is the inside bar.
Correct. So you can see how this bar is inside of the range of this bar right here, right? The range. So now I'm using the entire range, right? The high to the low, right? Yeah, it looks like it's a wide range bar. We're not going to use the term wide range bar to eliminate confusion. We're just going to say there was an extended move out of this consolidated area here. There's a nice extended move down, right? And it's, what neighborhood are we in? We're in the neighborhood of an important equilibrium, okay?
Okay.
So where price consolidates gives us clues, and so I'm like, okay, how many clues, can we have in here? And I think this clue right here is one of the most amazing clues, okay? Now, if we look at the tape above, right, the open, high, low, close up here, and I hover over this bar, Notice that the high of that bar is, what is it, 62,757, right? See that?
Yep.
62,757 is the high. Okay, price runs below, and clearly it's getting it's pinning away from the bottom of this, right? There's no close, and then look what happens. Right, so we said the high is 62,757. Now look at the close of this one. The close is 62,767. Price is closed out of the range of this inside bar. Price wants to go higher. But we have to wait for manipulation. And then we have to see price run back above this area right here, right? And there it is right there. Price pulls back, it's bought. See that? So we take the range of the inside bar across like this, right? You see that?
Yep.
It isn't until, so we need confirmation that there's truly buying here, okay? And so you can see price wants to go higher. Price closed out of the range of the inside bar. Price, boom, rockets below the equilibrium, right? So this is the case of the Quasimodo concept, right? You heard me talk about Quasimodo, which is the low, high, lower low, higher high, and the Quasimodo level.
Right.
So this is a low, this is a high, this is a lower low, this is a higher high, and then price retraces back to the Quasimodo level, roughly right about here. Okay, see this down bar right here?
Mm-hmm.
Heavy buying right here, right? So we had said, now you see how we use lower price action concepts to actually qualify this trade, if that's what you need, right? If you just want to stick with the daily chart, just add the close, right? We got the close, which was right here, then the pullback. But if you want to use lower price action, or lower time frame price action on the hourly chart to refine an entry, well, this is how I do it. I want to see price fall back like this, because what does this make people do? This makes people sell. They're like, oh, you know, it's what this is profit taking, right? Because look, there were buy stops right here.
Right.
But the clue that price wanted to go higher as it got close to the important equilibrium was right here. That was the first clue right there, even before we closed above the equilibrium on the daily chart. And I'm telling you that works probably, I would say, more than 90% of the time. And this is, as Michael Huddleston referred to it in some of his videos, this is super secret sauce.
Super secret sauce. Okay.
See, this is the Wyckoff concept. This is the spring right here.
Spring. Yep, that's the spring. And the spring is an action just below the previous lows that shakes everybody out, and then you have a compression of price that springs upward.
Right. So you can see this phenomenon on even on the higher time frame. Sometimes it's very apparent on daily charts, but again, you can just we can just go back to the daily chart and just, you know. So you were curious about how I would enter trades on a lower time frame. Well, that's how it would. That's how I generally do it. So I know that's a bit of extra minutia, and you know.
No, that's incredibly interesting. I think this is we've been going an hour and a half, and I think we've covered a lot of ground. And man, this is just incredibly interesting stuff. That's for sure. And the analysis here is just spot on, and I think that I think is very, very clear to me. And hopefully, if if you can review this video over and over again, the concepts are pretty simple. But what it really does is, I think it eliminates a lot of the confusion that people have, because when they're using 5 or 10 different indicators, or they're using moving averages, or they're trying to really fly by the seat of their pants, figuring out, well, gee, it looks like it's going up, or it looks like it's going down, so I'll take a long or a short. I mean, you really have something that you can use to determine whether or not where the smart money is moving. And that is the really key to the success in the market, I think. And you don't need a dozen different indicators. You don't even need two indicators, in my opinion. You know, you don't even need the EMAs. You don't need because all EMAs are always, you know, they're delayed price action. That's all they really are. So any closing thoughts here as we wrap up, how, you know, about price action in general and how to be more successful as a trader?
Yeah, I mean, it's just find a method that fits your personality and stick to that and nurture it. And because that's what, you know, I learned from Jack Schwaggart, is that he noticed about every trader that he ever interviewed was that they all found something that fit their personality.
Right.
And he showed how, you know, like, for example, I think it was it Paul Tudor? He talked about Paul Tudor Jones, right?
Oh yeah, he's one of my mentors. I've never met him, but I have read everything that he's written. I listened to every single one of his interviews. He was a stock market guru back in even in the 80s. Mm-hmm. He made tons of money in the 87 crash, and I started listening to him back then. He is just incredible.
The guy is just really, really, really good. He has a really good approach. And so he was just using the example of that. He goes, now let's take Paul Tudor Jones and compare and take him and put him in the world of this other trader that he was talking about. You know, Paul coming from an office where he has screens everywhere, and it's like the floor of the New York Stock Exchange. You know?
Right.
And so he says, but this other guy who's also a profitable trader, right, has his own very unique system and approach to the markets, and he sits in his master bedroom, you know, with no computers, right, and he has the newspaper, and he has his pen and notepad, and this guy kills it, crushes it, you know, and I think he said he's you know, has never lost more than 5% in any correction, you know, and this guy is just a very extremely profitable trader. Now, he says, now take Paul Tudor Jones and put him in that setting, and he'll just utterly fail. Have him switch places, and they'll just utterly fail. So the point is that he goes, they found a system that works for them.
Yeah, that is absolutely true. I saw a documentary, Paul Tudor Jones, one time, going all the way back to 1987. I think it was in about that time period. And, you know, it's all one of those, you know, really old shaky videos, and he's in his office just screaming orders. It looks totally chaotic, but it was exactly the way that it was based on his personality, his trading style that worked for him. And so you're absolutely right. I think you need to find the system and the you know, that works for you. I think that's absolutely true.
Well, you noticed I had an EMA on here, and I'm just trying to, now what is it? What's one of the most common EMAs that people use on the daily chart? Do you know? Because I really don't know.
I use a 20, 50, and a 200 sometimes. You know, and I look at the 50 and the 200 are the most common that most people use, because they look at when they cross. They think that, you know, there's some magic to that. It's called a golden cross if it's up.
That's the 50 and the 200, right?
Yeah, 50 and 200. Yeah.
So let's put that on there. Let's put the so is that the exponential moving average?
No, they use a simple moving average for the things to measure, like the death cross and things like that they use.
Okay, so that's going to be SMA.
Yeah.
Right. So let's simple moving average right here. Maybe they'll have it on here. Let's see.
You see that the way they use it typically is when the 50 crosses above the 200, then it's a golden cross, and, you know, it's supposed to indicate that the price is going to be moving higher. But by the time they cross, it's kind of too late in most, at least what I found in most cases.
Right. So it looks like you got a, let's see, which one is this?
Right there. That's the 50.
Right there?
I think so, yeah.
Yeah. So you can see how it really tries to keep you out of trying to find the bottoms.
Yeah.
Right. I mean, it's right here. It's I guess it's giving you somewhat of a signal. Isn't that kind of interesting?
Mm-hmm.
That we didn't even have to use a moving average to actually see that this was clearly an opportunity to trade.
Right.
right? Just based off of an equilibrium concept, right?
That's right. Actually, that's interesting that it crosses almost at the equilibrium at that point.
Right.
But I wouldn't use them. I typically do not use moving averages, but I like to look at price action bars myself, just like you do.
That's what I say. Hence, I rest my case. Price is everything.
Support resistance. I don't even use trend lines. I use support resistance, and I just look at the bars, and I look at wide ranging bars. I look at inside bars. I look at whether or not the previous bar is 50% of the current bar is 50% of the previous bar, that kind of thing. I agree 100% with everything that you said. I use maybe different language to describe it, but I think that we're very, very close in our analysis. But I think that I've learned quite a bit actually from what you described today. So again, thank you.
Oh, you're very welcome, Dave. It's my pleasure. You've been such a great help to me over the years, and I wouldn't be where I'm at if it wasn't for yourself. So I thank you for being my friend. Honor's all mine. So, but anyway,
thank you so much for your time. I really appreciate it, and we will be talking again very, very soon, I'm sure.